Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest. I'm speaking with Jordan Roy-Byrne, who runs the website, thedailygold.com. How you doing today, Jordan?
I'm great, Mike. Thanks for having me on.
Well, thanks for joining me, and I've got a lot to ask you about what's going on in the gold market, because there are lots of controversies on whether, the bull market's real and what's going on in the past couple of months. But before we do that, I just want to point out to people that we did an interview at the very beginning of August, and you told people during the interview to stay away from owning or buying JNUG and to buy individual stocks, to buy junior stocks, because they're more safe than JNUG is. And JNUG has fallen from around $34 to all the way down to 10. So thank goodness you were able to give that warning.
Well, yeah, I forgot about that, Mike. But it's interesting that that JNUG plummeted over the next couple months after that interview. And look, we're in a bull market for precious metals and for gold stocks. We appear to be in a correction consolidation. I think it appears that we hit a low last week. So the short-term trend in the days and weeks ahead is probably higher for the time being. But I still think we're going to remain in a larger consolidation into next year. But with that being said, yeah, this is just an example of why it's so dangerous to play those 3 times ETF vehicles, especially on the long side. I mean, trying to get greedy and aggressive after the market's already had a good run, and that's what can happen. Even though you're in a bull market, you could have bought at 34 and or 33, and it went all the way down below $10. I think it bottomed last week. So yeah, I mean that's you got to be really careful with those. We got to be really careful with anything in this sector, but you should avoid playing those 3 times ETFs on the long side unless you're just trying to do a short-term trade, because otherwise, Mike, you can lose a lot of money really quickly on those 3 times ETFs.
Well, even the ones that even when they go in the direction you want, it's still very difficult. For example, I had someone a few weeks ago boasting to me that they were shorting gold. This was like a day or two after it had the big drop day, and they were boasting to me, I'm shorting, I'm buying dust, and dust is 30, which is the 3 times short gold stock ETF. Dust is at 37 and it was at $50 when this guy was saying this. And the trouble is, even if the underlying market is going sideways, these ETFs have an erosion factor that can really tear up a portfolio. It's that's the irony. Is in August we're talking about the speculative junior mining stocks, which tend to be small cap stocks, and they're safer than these ETFs, as you pointed out.
Yeah, I mean, the thing with the 3 times ETFs, and I have used them for hedging purposes from time to time. I got really lucky. I'll just beat my own chest a little bit because I got really lucky the day before the sector was down 10% several weeks ago. I did put on a hedge trade, and as soon as it went down, I was in JDST, and I think this was at the beginning of October, and there was a day where the miners were down about 10%. And so I was up 30%. As soon as that happened, I just sold it, even though it went up a little bit more the next couple days. When you're playing these and you have that kind of a gain, you just have to take it and get out. I mean, these are just a short-term trading instrument. You're not trying to pick tops and bottoms. And like you said, Mike, there's an erosion factor. I mean, you could be right like I was for one day and suddenly be up 30%, but you could give most of that back in just a span of a couple days. So, I mean, that's why they're so dangerous. Like you said, there's an erosion factor to holding them for more than a couple days. That starts to kick in. And then it's just the compounding. If you're down one day and then you're down the next day, you can just get killed just with 2 straight days of it going against you. So that's why it's so dangerous.
Yeah, I mean, I've played double ETFs for the stock market, but I've never done it with gold myself. But everything can have its role if done right, even options, or futures. But Most, but the more volatile something is, then you can add on that decay factor, the more difficult it is. Well, let me ask you about gold. Of course, starting in July, gold peaked out around 1380. It went down to 1250. It's gone up about $20 in about 3 days here. Do you think that $20 move can be the low, or do you think we might be heading to bigger drops? I mean, there's some people saying the entire move was just a fake, a trick, and gold's going to go. I was listening to Nick Garino. He said it's going to go to 200. I think Harry Dent has a prophecy of economic collapse to send it to 500 or 400 or something, while Jim Rickards says 10,000. So how can I make a decision when there's all these conflicting predictions?
Well, the one thing is you should completely ignore predictions like those that you mentioned and try and focus on people who are giving you objective, fact-based analysis. I mean, that's what you really need to focus on, and not listen to people who are trying to sell you something at the same time and who are not giving any credence to those predictions. I mean, those are just $10,000 an ounce or 500. I mean, they're just totally ridiculous, and that's why we hear about those predictions, Mike. I mean, you don't hear about the guy who says, "Oh, I think gold's going to go to 1,500 in the next year," or "I think gold's going to go to 1,150 in the next year." You don't hear about those in the media because they're not interesting to talk about. Nobody really cares. They only want to talk about, who's calling for $500 gold and who's calling for $10,000 gold. I mean, people who are making those predictions, I think it's 90% marketing. I don't think they really believe what they're saying. When it comes down, I mean, are they putting their own money on the line, betting on that? Are they putting most of their own money on the line, betting on that? I don't think so. I mean, if Jim Rickards was so sure that $10,000 gold was going to happen as fast as he says, then I'm sure he would have a significant portion of his net worth in the precious metal space, and he's giving that prediction. And I could be wrong, but this is just from information I've gathered. But he also says only put 10% of your money in gold. So it kind of seems that those predictions, both on the up and down side, they're more of a marketing gimmick than based on fact-based reality. And I don't mean to go too off topic, but we can't see the future here. We can only look at the facts and what's objective, and then we can be reasonable from that. Now, with that diatribe aside, getting into the gold price, gold has made a low around 1250, which is a good support area. Now, it did have a good breakdown below 1300 to 1310. There is some resistance at 1280. So today it looks like we closed just pennies below 1270, but I think this rally can continue up to possibly as high as 1300, but it should get close to that, in my opinion. Now, is it possible that gold can make another low with respect to this correction? Yeah, I think that's possible. If you look at the strong support targets aside from 1250, there's very strong support around the 1210, 1215 area, and there's also very strong support at 1230, which is the 40-month moving average. And Mike, if you go back 50 years and look at the 40-month moving average in gold, it's just been an extremely important moving average as far as support and resistance. It's defined bull and bear markets over the decades. And the same can be said about the 20-month moving average, which comes into play at around, I think, 1205, 1210-ish, so just below that target I mentioned. So if gold was going to go lower, then I would tell you, yes, I think that the low for this correction would be 1230, or perhaps intraday as low as 1210, 1215. But I think that's kind of the negative or bearish scenario in the near term, the next month or two. But the bullish scenario would be that we've bottomed at 1250, and that after rallying up to 1300, we'd come back down, maybe retest 1250, consolidate, and then start to break higher early next year, and perhaps retest the highs around 1370. So I know that was a mouthful there, but I'm just trying to give you what I feel are the support targets if 1250 is not the low for this correction, and then also what might happen if 1250 is the low. I mean, I still think we're in a consolidation here, so it's going to take at least a couple more months of consolidation, in my opinion, before gold has a real chance to test its recent high and break to a new all-time high.
Well, that's one thing I really like about your work is, I'm asking you this, we're having this conversation, but you're basing what you're saying on past historical cycles and past corrections that have occurred, so we can kind of use them as a basis to have a feel for what could happen going forward. And with this, when I post this on the website, I'm going to have a link to an article you posted showing this. You have an analog chart showing corrections in 2001, 2002, 2006, comparing them to today. All these corrections occurred within a bull market. They all saw the HUI fall at least 20%, which isn't too shocking for the HUI Gold Stock Index. And we can use that as a basis to see what could potentially be happening going forward here to understand it. And one thing I like to add about your analog chart is that the 2002 correction and the 2001 correction happened after substantial advances in the price of gold stocks. And typically, when you see a market go up 100%, which is what the gold stocks have done, gone up more than that even, you do get a consolidation phase that lasts like your analog chart does.
Yeah, I mean, that's a great point, Mike. And, I think I used 3 examples there. And history rhymes. It doesn't repeat itself exactly. But what I see is I see similarities to the gold stocks. As far as their last move, I see the huge move you spoke of. I see similarities to 2001 and 2002. I don't want to go through all of them because I don't want to take up too much of the listeners' time. But in 2002, that correction lasted about 10 months, and it had, I think, 5 legs, whereas all the other corrections had the typical 3 legs, down, up, down. And at that 2002 peak, the gold stocks were extremely overbought, the most overbought they've ever been in like the last 20 years. They were up a huge amount in the past 16 months. So where we were a couple months ago, starting this correction, we were the second most overbought we've been in the last 20 plus years. So we were kind of close to as overbought as 2002, but we hadn't had the same appreciation in the last 18 to 24 months or so. But so I don't think this correction is going to last 10 months. I mean, what we've seen is the correction as far as price has been closer to 2002, but I think as far as time, I think this correction will be closer to 2001, which I believe was 5.5 or 6 months. And depending on how you look at it, right now we're in the 3rd or even the 4th month, depending on what indexes you look at, 3rd or 4th month of this correction. So that tells you we probably have a couple more months to go. And I mean, the last thing I'll just point out, Mike, all of those corrections, they at least had 3 legs. So they at least had a down, up, down. So there's going to be, even though it looks like we're rallying now, we could have a good rally, there's probably going to be another leg down. It's not necessarily going to make new lows, but I based on history, it's likely that that's going to happen. And I don't know when that next low could be. Maybe December, maybe it'll be the end of January, but sometime in the winter, I think that's when we'll see the next low and the end of this correction/consolidation. And I mean, again, we're looking out into the future, but if that plays out as we expect, then maybe at the end of the winter and into spring, that's when we start to see gold and gold stocks really pick up and try and make new highs again.
Yeah, and I think it's important for people really need to go and look at this chart to see what we're talking about. But one thing that's real important, I think, for people to understand is when you're talking about, and I agree with you, a correction that could last for months. The 2002 one was 10 months. That doesn't mean it fell every single month to new lows. It didn't do that.
Right.
It's a long, drawn out up and down consolidation thing, and it just, as you said, as you just pointed out, it should be getting ready, or is bouncing now. It should be a big bounce, and then some sort of retest or minor new low or something.
Absolutely, yeah. I mean, and that's what a consolidation is. It's basic. I mean, a correction, you're kind of looking at more a move down. It's kind of more short-term oriented, where a consolidation is basically something that happens. I mean, it can happen over a period of weeks, but with respect to gold stocks now in their history, I mean, consolidations, they tend to last at least several months, 5 or 6 months we were talking about before. And that's just normal. I mean, that's what happens after a market has a huge move higher. And, I mean, if you look at what happened after just look at the performance of the gold stocks after all those corrections on that analog chart. I mean, excuse me, after that 2002 10-month correction, I mean, they absolutely exploded over the next, I mean, I don't have it in front of me, but I think it was over the next 6 or 9 months or so. I mean, the gold stocks in 2003 just ripped much, much higher. And the same thing happened after the 2001 correction. So I think that's going to happen again with the gold stocks. But like I said, we're probably going to see some false moves, a lot of back and forth over the next couple of months until the consolidation is really mature. And then, I mean, if that happens as we think and as we expect, then gold and the gold stocks will be in position to try and retest their recent highs and then break and move to new highs.
Yeah, that'll mean an exciting 2017 for sure. The one last point I'll make about this is to go back to what we were talking about at the very beginning of JNUG is, if you're in a consolidation pattern, which is overall sideways, even if you were to get the exact low on JNUG, you still will probably end up losing money if you try to hold it, during that phase that lasts a couple months. But if you can get the right junior mining stocks and accumulate them during that time, you'll have a whole different story.
Absolutely, and like you were talking about before, there's not time erosion with the individual stocks.
Exactly. And as we wrap up, can you tell people what information you provide? I know you actually do provide a lot of information about individual junior mining stocks, and where can they go to get it?
They can go to my website, thedailygold.com. I put out a lot of free information there. I mean, my editorials, I write one per week, interviews like this, and I also conduct some interviews myself. So all that information you can find on thedailygold.com. You can also opt in there, and you can get my book, and you'll also get an additional report with that. And when you're on my free email list, every Sunday I send out an update, and I basically give my thoughts on what I think is happening with gold and gold stocks right now, and I provide a lot of other information, including a snippet or two from my premium update, which I send usually Saturday evening. I do one intensive premium update per week. So go to the website, thedailygold.com. You can opt in for my free newsletter, and there's also information on my premium service there where we cover things in more detail, and we cover the fundamentals of my favorite individual junior companies, which I'm personally investing in.
Well, thank you for taking the time to talk to me and my listeners, and we'll definitely do more follow-up interviews this year, next year.
Thanks for having me, Mike.